Hello and welcome to session 32 of the CEBRA Inflation Drivers and Dynamics webinar series. My name is Dominic Smith and I'm one of the organizers of the webinar series on behalf of the Central Bank Research Association. Raphael Schunla is the other co-organizer, and without much ado, let me pass the virtual stage onto Damjan Pfajfar, Vice President in the Research Department at the Federal Reserve Bank of Cleveland, who will be today's moderator.
Thank you, Dominic. The topics of today's sessions are: why has US inflation become harder to forecast? And inflation plucking cycles. Special thanks to the organizers, Raphael Schunla from Brandeis University and CEBRA, and Dominic Smith from the US Bureau of Labor Statistics. Let me first introduce the format. The webinar is 45 minutes with two presentations of approximately 15 minutes each, and then we'll have about 10 to 15 minutes for Q&A at the end. Attendees do not have the option to switch on their audio or video, but are invited to write comments or questions in the Q&A space. Attendees can, of course, pose their questions during the presentations already and do not have to wait until the end. The moderator will then select the questions to be answered in the Q&A portion of the webinar, which is after presentations. The webinar is also live streamed by the CEBRA YouTube channel, recorded and made available on the CEBRA website and CEBRA YouTube channel after the event. Disclaimer: participation in a CEBRA webinar does not constitute or imply an endorsement, recommendation, or favoring endorsement of views, opinions, products, or services of the Central Bank Research Association or any other participating institution, individual, or entity. All views expressed during a CEBRA or CEBRA co-hosted event are strictly those of the authors, discussants, and other participants, and not those of CEBRA, the co-sponsoring institutions, or any other participating institution. Let me introduce the speakers. Our first speaker today is Pablo Guerron from Boston College, and he will be talking about why has US inflation become harder to forecast. And the second speaker is Lihn Jørgensen from Copenhagen Business School, who will be talking about inflation plucking models. Pablo, you have 15 minutes.
Thank you, everyone, for inviting me to present my research. Let me start by sharing the presentation. Can you see it? Okay, thank you. So the title of this paper is Why Has Inflation Become Harder to Forecast? It's a redux that is going to become clear for those of you that don't know the title of this classic paper. This is with my amazing PhD student, Yang Liu. Okay, so there is this classic paper, I want to say it, in forecasting in general, and with an emphasis in US inflation that came in 2007 by Stock and Watson. So this paper tries to revisit this older paper. The bottom line of what Stock and Watson find in this paper is that inflation has become quite difficult to forecast in the last part of the 20th century, going up to 2005. How they make this analysis? Well, they use a battery of models, and in particular, they argue that the best way to capture the dynamics of inflation in the second half of the 20th century is using a trend cycle model that I'll explain in a moment exactly what it's about. They also find that what they call the trend level of inflation has declined since the 1980s, okay? And as a consequence of this decline in this trend inflation, forecasting models based on the Phillips curve, for example, have lost accuracy against models like the unobserved component model that I was mentioning. Okay. They used to make their case a battery of many models. These are unit-variate models, although they call one class multivariate, but these are just Phillips curves that are augmented with additional variables. But in essence, these are just unit-variate models that they use. So what we do in this paper, essentially, we extend the analysis of this amazing work by Stock and Watson to the sample 2005-2024. We think that this is very important to revisit because we have 3 important events during that period: the financial crisis, the unconventional monetary policy times in the US, and more recently, COVID-19 pandemic. In the paper, we focus on the PCE index and also its subcomponents. In what I'm going to tell you, because of the time limitations, I will focus on the PCE index by itself. Okay. The major findings of this paper is that when we look at the financial crisis, the drop in inflation was driven by transitory components. The pandemic was initially driven, the increasing inflation was initially driven by transitory components, but it became around 2021 clear that the permanent component was picking up, and it became the main driver of inflation. The other finding is that the volatility of inflation that we see during the last part of the 20th century and more recently is driven by transitory shocks rather than permanent shocks. So that's like a summary of what we find. Let me tell you quickly what is the model that we use to understand the recent events. You can see the model in 2 flavors. One is an integrated moving average that's on top of the screen. The reason why Stock and Watson motivate this model, this particular framework, is because they observe that there is a unit root behavior in inflation in the 20th century in the US. This integrated moving average model has a representation that has a state space representation. That's the one at the bottom of the screen, where inflation is decomposed into a permanent component that's denoted by tau, okay, and a transitory component, which is denoted by eta t, that's the shock. In the paper, they make the case, which for many of you is not surprising, that we need to augment this model with a stochastic volatility to improve its forecasting abilities. So that's the model. Okay. So we estimate the model using the original sample of Stock and Watson going to the year 2019. The reason why we stop in 2019 is because they estimate the model using a double-sided filter, which if you use the 2020-2024 data, is going to distort the estimates starting around 2015. So for that reason, we stop in the 4th quarter of 2019. You have the results over here. They are pretty similar to the conclusions that Stock and Watson have for the sample 2000-2005. So let me focus in the more recent periods. As you can see from the figures on the right side of the panel, you go to the financial crisis, that's 2008-2009. What you can see is a drop in the transitory component of inflation without much changes in the permanent component. In fact, you can see that the innovations to the permanent component of inflation are not statistically significant, different from 0. The last panel, the bottom panel, corresponds to the trend component of inflation. You can clearly see that it's coming down. You might ask yourself why is still positive when the permanent innovations are not different from 0. The reason is the inflation has been coming down since the late 1980s, so there is momentum in the permanent component of inflation. That momentum starts to wind off around 2010, I want to say, and remains close to 0 for the rest of that sample. Okay. If we look at the COVID-19 period, then the results can be decomposed in 3 components. The initial shock or the initial change in inflation was driven by a deflationary transitory shock in the first quarter of 2020. Okay. Then we have the picking up of inflation, and that is initially a contribution of transitory elements that then quickly switch it to what the model picks up as a permanent component of inflation. What we find very telling from this decomposition is that the risk of high inflation in the US remains elevated, even going to 2024. This is before all the noise that is being introduced because of the changes in economic policy in the US. Okay, so let me show you probably the next figure. This one is more interesting. So here what we have, let me concentrate on the right and left-hand side of this figure. What you have is this spaghetti representation. These are the real-time estimates. Each line that you see and a dot at the end, that's a real-time estimate of the permanent component of inflation using data up to the point where the dot ends at the end of the line. So here you can see going into 2020, you can see that the drop in inflation was initially coming from the transitory component. You can see the permanent component is pretty flat going to the first quarter of 2021. And then you can see these blue lines start to go up, which means that in real time, the model is moving the high inflation away from the transitory component into the permanent component. The black solid line that you have over there is the Fed's fund rate, just to give a context that when the Fed started moving, increasing the rates versus the peak of the permanent component of inflation, which happened at the end of 2021, early 2022. Okay? So that's what you can see from this figure. Let me move to this second figure. So here what we have, again, is real-time estimates, but now the volatility component of the permanent part of inflation. For those of you that are familiar with the risk uncertainty literature, these stochastic volatility components can be interpreted as measures of the amount of risk on a given variable. So here, that variable is the permanent component of inflation. And as you can see from this, the figures, it was initially flat, close to zero, and eventually move up. And we can see that by the end of the sample, which is now the first quarter of 2025, the risk of high inflation remains elevated compared to when we started in 2020. Okay. So how much time do I have left?
So you have 6 minutes left.
How many?
6.
Okay. So this is a part of the paper. We do many more analysis, but one that we found quite important to revisit is how easy it is for models to forecast the COVID episode. So what we did in the paper is to take initially 2 models that we noticed in our forecast analysis in the 2010-2019 analysis. We realized that the unobserved component stochastic volatility model started to lose its forecasting abilities. And at the same time, we noticed that an autoregressive model optimally selected with AIC improve its forecasting abilities. Okay, so we did the out-of-sample forecast for the 1 quarter ahead and the 1 year ahead for the sample 20 Q1, 24 Q3. And you can clearly see that the autoregressive model in the first row is superior to the unobserved stochastic volatility component. Okay, so that was the first lesson that we learned, that as the data became more volatile, less stable, is easier to forecast, or is better to forecast with autoregressive, with simpler models, rather than with the more structural, more elaborated unobserved component and stochastic volatility. The third line, the third row that you see here, this is a new class of models that are actually being developed outside economics. These are being developed mostly by companies like Amazon. This particular toolbox is from Amazon, but there are equivalents from Meta, from Google, and the likes. This library or this toolbox is called Chronos, is what is called a foundational time series model. It's essentially on the background, there is a large language model. And the large language model is going to do the forecasting. I'm not going to go to the details. You can look in the paper. We have a nice introduction on how these models work. To our surprise, you can see that the mean square error of this model is quite small compared to the other two contenders. What is interesting about this new class of models is that Chronos is never estimated with actual inflation data. It's what is called a zero-shot forecast, that you feed the data and the machine will tell you what is the best prediction for the particular sample. So as I said, in the paper, we have a more analysis. One of the key findings, once you go to the subcomponents of inflation, we notice that the services part of PCE became harder to forecast. That's the reason why we see this switch moving away from the unobserved components stochastic volatility model into the autoregressive ones. If you do this analysis at the subcomponent level, you will notice that everything is coming from services. The non-services elements continue to be predictable, continue to be well described by the unobserved component model. And let me stop here.
Thank you very much. Should we go to the next presentation? Peter, Lihn.
Can you see my slides?
Yes, I can see.
All right. Thank you very much. First, thanks to Raphael and Dominic for inviting us to present this paper at the CEBRA webinar, which is titled Inflation Plucking Cycles, and it's joint work with Oscar Juhl, who's a PhD student here at Copenhagen Business School. And it's a preliminary paper, so all comments and suggestions are very welcome. So the term plucking was coined by Milton Friedman to describe the dynamics of US business cycles. So Friedman, according to Friedman, output frequently drops below its longer-term trend, but rarely rises above it. And therefore, as Friedman wrote, output is viewed as bumping along the ceiling of maximum feasible output, except that every now and then it is plucked down by a cyclical contraction. So Friedman noted that a testable implication of the plucking theory is that the size of an expansion, that the size of a recession should predict the size of the subsequent expansion, but that the size of an expansion should not predict the size of the subsequent recession. And in a recent paper, Stefan Duprat, Amy Nakamura, and John Steinton show that the behavior of the US unemployment rate is consistent with that pattern. So the US unemployment rate displays positively skewed plucking cycles. So to the best of our knowledge, our paper is the first to extend the concept of plucking to inflation dynamics. So we provide empirical evidence of inflation plucking cycles in nearly all OECD countries. So specifically 33 out of 38 OECD countries, including the US. So specifically, we show that increases in inflation are followed by decreases of similar amplitude, but that the amplitude of a decrease does not predict the amplitude of a subsequent increase. And then we extend an otherwise standard new Keynesian model with a scarce non-labor input with low substitutability in production. And we show that the nonlinear version of that model, which we solve globally, can match the plucking property. And that model gives rise to a convex price-Phillips curve, a positive inflation bias, and a negative output gap bias. So inflation will on average exceed the central bank's inflation target, and output will on average fall short of its sufficient level. Then we solved the fully nonlinear Ramsey problem under commitment, and we showed that optimal monetary policy responds aggressively to large negative supply shocks while accommodating large positive supply shocks. And that policy serves to mitigate the inflation and output gap biases, generating sizable welfare gains. The latter is a work in progress, so I'm not going to talk about that today. Great. In the interest of time, I'm going to skip the related literature and proceed to the empirical evidence. So first, we collect quarterly inflation data for all 38 OECD countries, and for most countries, these data are available since 1960. And we run both cross-country and country-specific regressions, and we identify inflation peaks and troughs using the algorithm developed by Duprez, Nakamura, and Steinson. And this figure here shows you inflation in 4 of the OECD countries, Germany, Japan, UK, and US, along with our identified peaks and troughs. So the blue vertical lines mark inflation troughs, and red vertical lines mark inflation peaks. Great. Then we compute the amplitudes of all of these increases and decreases and look at the relationship between them. And this shows you the relationship for the US. So the left-hand panel here shows you on the first axis the amplitude of increases in US inflation versus amplitudes of subsequent reductions. And what we see is that the very strong positive relationship between the size of an increase and the size of the subsequent reduction. And this dashed line right here, that's an OLS regression line, and it roughly corresponds to a 45-degree line, meaning an increase in inflation is followed by a similar sized decline. And that relationship is significant at the 1% level with an R-squared of 0.62. In contrast, the relationship between amplitudes of decreases in inflation and subsequent increases is pretty much non-existent. So this relationship is not significant, and the R-squared of this regression is 0. And the same pattern shows up in OECD cross-country data. So once again, here we see that when we look at amplitudes of increases in inflation in OECD countries versus subsequent or amplitudes of subsequent reductions, we have once again roughly a 45-degree regression line, so a 1-for-1 relationship, and an R-squared of 0.42. And over here, we have actually a significant relationship, but the regression coefficient is close to 0, and the R-squared is also very close to 0. So here we see the regression results, where for the United States, we have, when we regress the size of an increase on the size of the subsequent reduction, we get a 1-to-1 relationship and a high R-squared. And when we do it the other way around, so to speak, we don't see any relationship whatsoever. For the OECD, the pattern is the same, except that now with the second regression, we have a sufficient number of observations to obtain a significant coefficient, but the coefficient is very small, much smaller than over here, and the R-squared is still 0. And we do a bunch of robustness checks, but I'm not gonna get into that due to time limits. Let's turn to the model which can help explain these inflation plucking cycles. So just a brief sketch of the model. It's a standard new Keynesian model with sticky prices and wages a la Rodenberg. Monetary policy follows a Taylor rule, and we have government subsidies to ensure an efficient steady state. The non-standard features are that we have this scarce non-labor production input with low substitutability in production, and that we solve the model globally to preserve the nonlinear features of the model. So the key nonlinearity in the model is that intermediate goods producers use a CES production function, which looks like this. So they use labor and this non-labor input, which we call X. And phi is then the elasticity of substitution, which we assume attains a near 0 value. And what we have in mind for this non-labor input, which is nearly non-substitutable, would be, we have a generalized interpretation of it, but a prominent example, which would of course be energy, but it could also be different types of specialized capital, like microchips, for instance, that have been in the spotlight during the post-pandemic period. And the supply shocks in the model is a shock directly to X. So X follows this stochastic process right here. Okay. What's the intuition behind these inflation plucking cycles in this model? Well, marginal cost can be written like this. So it can be written as a function of the real wage and the input ratio, the LX ratio. And it's straightforward to show that in the Lihn limit, so that's when the elasticity of substitution goes to 0, that we obtain this marginal cost function right here. So just to give you a bit of intuition, assume we have a large positive supply shock, which raises the value of X. Well, in that case, X is abundant and marginal cost will be determined by the real wage. On the other hand, if we have a large negative supply shock, which reduces X, well, then the marginal product of labor goes to 0 and marginal cost explode. So that gives you this these kink marginal costs, which translate into these inflation plucking cycles. Okay, I'm going to skip the calibration, just point out that we use a value of 0.01 for the elasticity of substitution, which is within the range of standard values in the production network literature. Great. Quantitative analysis. So first, the upper panel here shows you 2 simulations of inflation of each of 100 quarters. And the blue lines is the blue line is from the linear solution, and the black line is from the global fully non-linear solution. Now we can see that inflation behaves very similarly in these 2 models, except when the economy is subject to a large negative supply shock. So that's what happens here, and that's what happens here. So in that case, in the fully non-linear model, inflation will increase a lot more than in the linear model. But otherwise, the 2 models behave fairly similarly. But it is that feature of the model that allows us to account for the plucking cycles we observe in the data. So here we see the same type of regressions that I showed you for the data, but using model-generated data. So the linear model will have symmetric prediction power. So these 2 regression lines are the same, roughly the same, and the R-squareds of those regressions are also roughly the same and relatively low. But in contrast with the global solution, we obtain this 1-for-1 relationship between increased amplitudes and subsequent decreased amplitudes, and a very high R-squared around 0.8. And in contrast, we obtain nearly no relationship between the amplitude of a decrease and the amplitude of the subsequent increase, with an R-squared around 0. And here are the regression results from the model-generated data, which is very similar over here for the global solution, very similar to what we observed in the actual data. Great. Okay, so the model, the nonlinear model, gives rise to a highly convex price Phillips curve. And just for illustrative purposes, let's assume that wages are just flexible for a moment. In that case, as it's well known, the linearized version of this model will entail a simple New Keynesian Phillips curve, where inflation is simply a function of expected inflation and the output gap. And given our calibration, expected inflation here will just be equal to 0. So the structural Phillips curve is just a relationship between inflation and the output gap. And the blue line here is that relationship from the linear model. The black line is then the same relationship, but from the nonlinear model, and we see that is highly convex due to this nonlinear production function. And the figure also shows you the average values of the output gap and inflation implied by each model. So by construction in a linear model, the output gap will be 0, and inflation will be equal to the Fed's inflation target, which will then be 0 in this case. But when you have a highly convex Phillips curve, that will give rise to a positive inflation bias and a negative output gap bias. Because a large negative supply shock will disproportionately increase inflation, whereas a large positive supply shock will disproportionately reduce the output gap. So you end up with these biases that generate welfare losses, of course. Great. Okay, so as I mentioned earlier, so the main difference between the linear and nonlinear model is when the model is subject to a large negative supply shock. So let's look into to that case. So this graph shows you the impulse response functions to a small negative supply shock versus a large negative supply shock. And the impulse responses from the small shock are scaled by the relative shock size. So the large shock is roughly 3 times larger, or it is 3 times larger than the small shock. So that means we multiply the impulse responses to the small shock by 3. So that means that the remaining difference is not due to different shock sizes per se, but it's due to the nonlinear transmission of large shocks. And what we see, first note that in response to the large shock, this is the value function, so that's our welfare measure. In response to a large negative supply shock, welfare will decline disproportionately. And it will decline in a persistent manner. Okay, why is that? Well, in response to a large negative supply shock, the output gap will increase slightly more than proportionally. But inflation, because we have a convex price Phillips curve, inflation will increase much more than proportionally. So you get this inflation burst. And the shock is IID, so it's gone after 1 period. But then afterwards, we still have very low welfare because this inflation burst will lead to a disproportionately large reduction in the real wage. And because wages are relatively rigid, it will take a very long time for the real wage to recover. And that period, long-lasting period, is characterized by positive wage inflation, which is also costly from a welfare perspective. So we would expect the Ramsey planner to be more concerned about large negative supply shocks than small negative supply shocks. So let's just look at that case with a Ramsey planner. So we solved the fully nonlinear Ramsey problem under commitment. And note that when you have the Ramsey equations, the state space becomes too large for a global solution. So instead, we rely on a 5th order approximation, which we show is highly accurate in the model with the Taylor rule. So here are the same impulse response functions, but from the model with a Ramsey planner instead of a Taylor rule. And what we see here is that the impulse response functions nearly coincide. So that means that the Ramsey planner will almost completely neutralize the nonlinear effects of the large shock. So the Ramsey planner will not allow inflation to increase disproportionately or the real wage to decline more than proportionally with the shock. And how can the Ramsey planner neutralize all of these nonlinear effects? Well, again, we have to remember that the price Phillips curve in this model is highly convex. So that means that when we are on the steep part of the Phillips curve, then the sacrifice ratio is very, very low. So that means that the Ramsey planner can reduce inflation without substantially reducing the output gap. And by stabilizing inflation on impact, you stabilize the real wage and you avoid this long-lasting period of costly nominal wage adjustment, which is very much welfare improving. Great. So to wrap up, we provide empirical evidence of inflation plugging cycles in nearly all OECD countries. So specifically, we show that increases in inflation are followed by decreases of a similar size, but that the amplitude of a decrease does not predict the amplitude of the subsequent increase. The nonlinear version of a standard model, extended with a scarce non-labor production input with low substitutability in production, can account for the plugging property. That model gives rise to a convex price Phillips curve, a positive inflation bias, and a negative output gap bias. And optimal monetary policy should respond aggressively to large negative supply shocks while accommodating large positive supply shocks. So that policy mitigates these inflation and output gap biases that arise with the Taylor rule and that generate sizable welfare gains. But again, that part is work in progress. And that's about it. So thanks for your time. Here's a link to the paper. Thank you.
Thank you very much. Now I will open to questions. We received some questions. The first questions are for Pablo. So Dominic is asking, it seems that like during the pandemic, the forecasting models that perform best are those that were most aggressive forecasting higher future inflation as soon as inflation started to rise, instead of some mean reversion property that we often see in forecasting models. Do you have a sense of whether these models are too aggressive in earlier periods, say 2010, when inflation picked up for a month or two before returning to the long-term trend? So that's the first question. Randy is asking sort of similar question. That's basically he expects that there is a time variation in which model does best for forecasting inflation. For example, like a Phillips curve model can do very well during the financial collapse and recovery compared to the unobserved component stochastic volatility model. Pablo, any quick reactions?
Yes, I agree with Dominic. Actually, in the paper, we have the mean square errors from multiple models. You can precisely see that the autoregressive models' abilities deteriorate significantly during the financial crisis. So if you send me an email, I'll send you the paper, and then you can see, or we can discuss in more details this aspect. And that's related with Randy's point. We didn't try the Phillips curve, but given the recent evidence of people finding that the Phillips curve is alive and kicking, my sense is that the Phillips curve forecast will do better than the UC stochastic volatility component. But that's something that we haven't tried, but given this very important point, is something that I guess we will include it in the revised version.
Pablo, have you compared, for example, the forecasting performance compared to professional forecasters? How your models perform vis-a-vis them in different periods?
No, but I guess we could use SPF to see it in the, that's a very good point. The reason we didn't do it is because Stock and Watson didn't do it in that their paper, but that doesn't mean that we shouldn't include it now. Yeah, that's another good observation.
Very good. For Peter, perhaps can you explain a little bit about the role of non-linearities exactly for your results? So basically, you're emphasizing the convex Phillips curve, and how convex is your convex Phillips curve in essence? And why am I asking this? Is in a sense, it's if the central bank has an inflation target, and if you assume that the monetary policy is effective, then it's sort of natural that you might have a temporary increase in inflation, but that you will bring that inflation back to the target. However, you also show here that you generate two biases, and that optimal policy could correct for these two biases in essence. Yeah.
Yeah. So the Phillips curve, conditional on supply shocks in our model, the Phillips curve is highly convex. So we obtain like with an output gap of like 0.5% plus 0.5%, you obtain like inflation rates of like 8%. So it is highly convex.
Oh, this is highly convex. Yes. Okay.
Very convex. Yeah. So in response to supply shocks, we also look at demand shocks in the model, and it's much less convex in response to monetary shocks. So supply shocks are really can give rise to these super large inflation bursts, and for policy, it's extremely important, right? Because it means that if you don't respond to inflation on impact, you're going to have this disproportionately large increase in inflation that lowers the real wage and a bunch of welfare losses associated with that. But it's a double-edged sword. So if you respond to inflation, then you're facing a convex price Phillips curve, so a low sacrifice ratio. So stabilizing inflation is not very costly. So to answer your question,
yeah,
it is highly convex, and that's of course very, very important for policy.
Yeah. So in a sense, your your empirical part of the paper is talking about the behavior of inflation, but then perhaps do you have any empirical evidence of the specific mechanism that you just outlined, so that in response to the supply shocks, the Phillips curve become much more convex than compared to the demand shock, and on the degree of convexity?
Right, that's a very good question. So at this point, so again, this is the preliminary work. So at this point, we don't have additional empirical evidence like supporting. We can match the inflation plucking cycle moment, but definitely other models would also be able to match that. So we have the same mechanism that generates inflation plucking cycles in our model also give rise to this convex price Phillips curve. So I definitely think it would be relevant to look at additional empirical evidence in favor of the state dependence and the convex price Phillips curve to kind of back up our specific mechanism. That would definitely be a good idea. Yeah.
Very good. Do we have any other questions for two presenters? If not, I will say thank you to both of presenters. It was two very interesting presentation and interesting discussion. So thank you very much for participating in this CEBRA co-hosted event.
Thanks a lot for the invitation.
Thanks, everybody.
Thank you.
Thank you.